So how can people, build a reliable monthly income in euro when their savings are still in dollars?
Yeah, it's a good question. I think something we get asked quite a lot. I think to caveat this is super personalized. So depending, building a reliable monthly income and making sure it's actually sustainable for their life, and make sure they don't run out of money before they do pass away. That does come down to every specific case. How much assets you've got at the moment, when do you plan on actually retiring, how much income do you need versus the amount of assets you do have. And we will discuss how to actually set this up through the case study through a kind of generalized case. But essentially, the most sustainable way is actually using dividends and interests from your different accounts. So somebody did mention in the chat about a dividend or income strategy being taxed heavily, and to be completely honest, it depends on what structure you're taking it from. If you've only got retirement assets like 401k, IRA, etc., then dividends, etc., are always going to be taxed at income tax in Spain, because you're always going to have to take a distribution from that asset. Whereas if it's from a brokerage account, for example, is going to be taxed as savings tax in Spain. So it's understanding where to actually take that money from as the first instance. But the way that we would actually set this up is, let's say somebody has $1 million. If they only want, say, 100,000, well, we can target dividends and interest of 5 to 6%. We know that's going to give them a really stable quarterly income and an annual income of 50,000, because we know every single quarter that income is going to get kicked out from what we're invested into. Using mutual funds and ETFs, you might not be able to actually be as bespoke as that. So ETFs and mutual funds are often good for the kind of growthier phase, maybe, but not necessarily from an income orientated stage. We can then use, the capital growth, etc., on top of that to be able to actually get them up to that income goal that they need. That means they're not touching the capital. They have a little bit of leeway for them to be able to, have a bit of an additional expenditure if there is those ad hoc lump sums they need. But also importantly, if they do have beneficiaries, children, etc., it means they can also then pass on as much assets as possible to them. Of course, if that is one of their objectives. If not, and they want to die with zero, which also is the case when we speak to people, then we can build that into the plan to actually show how we can get them the highest possible income based on their assets and making sure that lasts them.
And Steve, can you cover a bit of the transfer setup part of things when it comes to building that reliable monthly income, and what needs to be, what should they consider?
Yeah, certainly. So you've got the use of the forward contract, the buy now, pay later. The volatility of the last 12 months has been staggering, huge, 10+% movement. So you want to protect that to make sure your living costs are protected. We can do automatic and rebuy. So we call it a regular payment plan, which is something we actually created in the industry 18, 19 years ago, I think. So that allows you to set up payments through, and it's automatically distributed and sent through. So most clients use this for the first transfer and many, many transfers thereafter. We will respectively become friends through the progress of your move. So yes, we have a solution for this to help.
Now, how about the question that's on everyone's mind? So when if the dollar weakens and their spending powers is in Spain drops, how can they protect themselves against that long term? So again, Steve.
Follow someone on Twitter or X to find out what's going on, obviously, how quickly it changes what the world looks like. But the forward contract's the tool. The forward contract and the updates and having regular check-ins to make sure the power of your dollar is protected. The forward contract I've alluded to and covered, but what I haven't highlighted is a forward contract can go for up to 2 years. So it can give you some real longevity of your cost of living.
Great.
I think I could also jump in there quickly and just say 2 very quick points. If you've got retirement assets and you can't, of course, invest into euros or remove them from the States, having some form of international exposure within those underlying assets can help, diversify you away from, the US focused market, which might bring about some currency diversification. If you do have brokerage accounts or cash, ways to reduce that currency risk is to simply use some form of US compliant, PFIC compliant portfolio outside of the States, which is investing into euro denominated funds or direct securities, and that way you've removed yourself completely from US focused assets and USD currency. And that's really the only two ways from a specific investment perspective that you can get yourself away from the dollar fluctuating as much as it has been.